Hello traders around the world. This information about taxes is useful. I wanted to share it with you. Taxes and their impact on economies. Why countries choose to raise or lower taxes. Taxes have been a cornerstone of economic systems for centuries, serving as a primary source of revenue for governments. They play a critical role in shaping the economic landscape of nations, influencing growth, income distribution, and public services. This article explores the concept of taxes, their historical origins, their impact on economies, and why countries choose to raise or lower them. What are taxes? Taxes are mandatory financial charges imposed by governments on individuals, businesses, and other entities to fund public expenditures. These include infrastructure development, healthcare, education, defense, and social welfare programs. Taxes can take various forms, such as income tax, sales tax, corporate tax, property tax, and customs duties. Historical origins of taxes. Taxation dates back to ancient civilizations. One of the earliest recorded systems of taxation was in ancient Egypt around 3000 BC, where the pharaoh collected taxes in the form of grain. Similarly, in ancient Mesopotamia, taxes were levied on crops and livestock. The Roman Empire also implemented a sophisticated tax system to fund its vast military and administrative expenses. Modern taxation systems began to take shape in the 17th and 18th centuries, particularly in Europe. Income tax, as we know it today, was first introduced in Great Britain in 1799 to fund the Napoleonic Wars. Since then, taxation has evolved into a complex and integral part of national economies worldwide. The impact of taxes on economies. Taxes have a profound impact on economies, influencing both macroeconomic stability and individual behavior. The effects of raising or lowering taxes can be seen in several key areas. 1. Economic growth. Raising taxes. Higher taxes can reduce disposable income for individuals and profits for businesses, potentially slowing down consumer spending and investment. However, if the additional revenue is used effectively for public infrastructure or education, it can stimulate long-term growth. Lowering taxes. Reducing taxes can boost disposable income and encourage spending and investment, leading to short-term economic growth. However, if not balanced with spending cuts, it can lead to budget deficits and increased national debt. 2. Income inequality. Progressive tax systems, where higher earners pay a larger percentage of their income, can reduce income inequality. Conversely, regressive taxes, like sales taxes, can disproportionately affect lower income groups. 3. Public services. Taxes fund essential public services such as healthcare, education, and infrastructure. Raising taxes can improve the quality and availability of these services, while lowering taxes may lead to cuts in public spending. 4th. Business environment. Corporate taxes influence business decisions, including investment and location choices. Lower corporate taxes can attract foreign investment, while higher taxes may discourage it. Why do countries raise or lower taxes? Governments adjust tax policies based on economic conditions, political priorities, and social needs. Here are some reasons why countries choose to raise or lower taxes. 1. Raising taxes. To address budget deficits and reduce national debt. To fund new or expanded public services and infrastructure projects. To reduce income inequality through progressive taxation. To curb inflation by reducing disposable income and demand. 2. Lowering taxes. To stimulate economic growth during recessions or periods of low activity. To attract foreign investment and boost competitiveness. To increase disposable income and encourage consumer spending. to support specific industries or sectors. Examples of tax policies in practice. United States. The US has historically adjusted tax rates to stimulate economic growth. For example, the Tax Cuts and Jobs Act of 2017 significantly reduced corporate tax rates to encourage investment. Scandinavian countries. Nations like Sweden and Denmark have high tax rates to fund extensive welfare systems and public services, resulting in low income inequality and high living standards. Singapore. Known for its low tax rates, Singapore attracts global businesses and maintains a competitive economy. Conclusion. Taxes are a powerful tool for governments to manage economies, fund public services, and address social issues. Whether to raise or lower taxes depends on a country's economic goals, political priorities, and social needs. While higher taxes can fund essential services and reduce inequality, lower taxes can stimulate growth and attract investment. Striking the right balance is key to the. Thank you for listening. Goodbye.